So what you actually have is a deflating debt bubble in terms of the asset valuations that's pushing rates. It's causing a bit of a dollar bubble, and at the same time, it's crowding a lot of capital into the equity markets. And more of that money should, in fact, be going to gold. But initially, because of that dollar strength and people trained to be kind of a little bit not on gold, don't forget there's interest rates going up on the 10-year, will potentially point to better yields coming. So people will rather hold dollars and earn yield than hold gold for now. Until such time as the contagion becomes disorderly, then everyone goes capital preservation. And then instead of all that bond money going into the overpriced equity market, we may see a bigger slice ending up in the precious metals.
The first trading day of 2025 witnessed gold prices advancing globally, with the precious metal gaining $10 per ounce to reach $2,624 in the international bullion market. While gold demonstrated solid gains, silver showed a modest decline during midday U.S. trading on Tuesday as market participants engaged in position-taking across various sectors, including precious metals. The precious metals performance in 2024 was marked by historic highs, driven primarily by substantial central bank acquisitions and heightened geopolitical tensions. Notable purchasing activity came from emerging markets, particularly China, India, and Turkey, as these nations moved to strengthen their reserves. Market analyst FrancisHunt's year-end analysis presents a nuanced outlook for gold in 2025. While maintaining a long-term target of nearly $3,000, Hunt identifies potential near-term challenges within the current trading channel. The grinding market structure suggests possible downward pressure, potentially leading to a temporary pullback before reaching higher targets. Market analysts agree that surpassing the $2,800 threshold would mark a significant technical breakthrough, potentially accelerating toward the $3,000 level in 2025. However, market consensus indicates that sideways trading patterns may characterize the year's initial months. The strength of the U.S. dollar is affecting precious metal markets, with the dollar index testing resistance levels between 108.30 and 108.50. This trend follows the Case-Shiller Home Price Index report, which showed a 0.2% month-over-month decline in October. Analysts explain the dollar's strength due to high U.S. interest rates and falling debt valuations, creating challenges for gold and silver while offering potential buying opportunities during price corrections. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Let's show you the gold, and then I'll roll into, if that's okay with you, the third indicator, because they go hand in hand. I'm a tiny bit concerned about the price action here. We are in this channel. So you will recall us, we were with you actually when we said this little setup is going to be a golden moment to be even leverage long. We don't purport everyone should utilize leverage without understanding the risk, but we were, and this was a very nice, in short duration move before we went into a little bit of containing and squeezed high up to here. We still have the targets, by the way, that we've given you, which are just sub the 3,000 awaiting us, but there could be a little bit of a detour. I'm not mad for this grinding structure under here, and there could be a test for us below this larger channel. We might get a little bit of a breakdown out of this channel. And I'm going to roll into the gold-silver ratio as to why I think it's going to be a sideways poor and maybe downside environment for precious metals short term. So as I say, this doesn't change our macro bull bias, but there's times when we are, saying get leveraged and really enjoy the ride, like over here. And there's times where I say I wouldn't be leveraged long at this point in time, and that would be right now. The gold-silver ratio is our triggering event number 3. So a little bit of concern about gold's place, and probably maybe even more concern with the gold-silver ratio. And we've said once this sell-off here never followed through, you may recall we thought there's a real chance, and we had a silver surge during this period that got us into the 30s and out of the 20s. And we even broke 75, a key level, but we couldn't hold it. We came back up, and then we really bounced back hard. So in the end, we never got away. It was a bit of a fake out break. And then we said that's a problem and a concern. It points to this overall gold-silver ratio more likely treating this structure as a continuation structure with a break to the upside. So we're unfortunately kicking the can down for those patient silver investors, and even giving some dull to disappointing news to gold holders in terms of price performance short term. So it will be a great period to buy dips, and the dips may indeed be coming for the true and faithful and the patient. And this triggered here, and that points to gold-silver ratio going higher. And that's normally associated with a risk-off type vibe, dollar dominance, and we'll be coming back to that. We've already spoken about the rates hike, disproportionately high rates in the US due to collapsing valuations on debt, not a healthy dollar strength, but the schizo dollar strength. And I think this is going to work exactly against gold and silver. And we're seeing this in the gold-silver ratio as the ratio is stretching again and may even get back into triple figures, but looks like it's going to take a walk into the deeper 90s at the moment. And that is our third reason why we're expecting some potential crisis to occur that's going to lead to that very, very dominant gold about that dollar, very dominant dollar strength, which is going to be a headwind for gold and silver.
Financial markets entered a period of adjustment on Tuesday as global stocks retreated, marking their fourth consecutive daily decline amid rising U.S. Treasury yields. This market behavior concludes what has otherwise been a robust year for equity performance. Market analyst FrancisHunt provides insight into the complex relationship between debt markets and precious metals. Hunt explains that the ongoing deflation of the debt bubble is creating an unexpected strengthening of the U.S. dollar, which has prompted investors to redirect capital from gold to equity markets. The current high interest rate environment has enhanced the appeal of yield-generating assets. However, Hunt suggests this dynamic could shift if market instability intensifies, potentially driving investors toward precious metals as a safety measure. Adding to the market discourse, Tesla CEO Elon Musk has raised significant concerns regarding the United States' fiscal position. During an appearance on the Joe Rogan Experience, Musk highlighted the gravity of the national debt, which has reached $36.17 trillion. His warning about potential dollar devaluation underscores the traditional argument for gold as a hedge against currency depreciation. Let's get back to the interview.
Now, as these interest rates get more expensive and the market is almost taking the pricing away from the Fed, that is part and parcel of that 2020 call we made of debt-based collapse. And that is seen in assets which are basically the inverse of this chart. But if you'll allow me, I'll pull up the TLT and show you that this is in effect a long-term debt ETF. And it has done nothing but fall since 2020. So let's get a big enough chart for you to see. You were up at 180 and you've just broken down out of this rising wedge in the same way that the yields have broken up against a falling wedge. So you can see that natural inversion between valuations and interest rate. So that's point number one. You are seeing chronic debt devaluation. If it gets further disorderly and the triggering event of that falling wedge break that I showed you in the initial chart is a potential warning, you are seeing debt-based collapse and it's leading to schizophrenic dollar strength for now. That's a technical shoe to drop number one. I'd just like to hand the talking stick back to you because you may want to come back at me before I go into the next ones. In essence, that's why it was quite a hawkish cut that they gave recently. And that's part and parcel because of the devaluation of the asset. So the Fed is caught between, we let some steam out of this debt market's valuations and we let it sell off badly. The response, what it does is it keeps a lid on inflation because you're getting this dollar appreciation. So all your imports are relatively cheap. So it'll keep a slight lid on inflation, although inflation is showing its head and will resume in our overall opinion. So it makes the inflation a little bit more everybody else's problem that's not in dollars for a while. But eventually, if you get a one-way bet on the downside of the debt markets, it could turn into contagion. And then you get an asset-based collapse there. And that's a very, very negative thing. It's also, I think, one of the reasons why so much money is flooded into the equity markets. And you have people like Daniela DiMartino Booth and other analysts saying you're in the top 2% of hypervaluations of all time. You only spend that amount of time at these extreme valuations in terms of PEs, CAPEs, various other sort of market cap to sales type valuations in the stock market. So what you actually have is a deflating debt bubble in terms of the asset valuations that's pushing rates. It's causing a bit of a dollar bubble. And at the same time, it's crowding a lot of capital into the equity markets. And more of that money should, in fact, be going to gold. But initially, because of that dollar strength and people trained to be kind of a little bit not on gold, gold, don't forget there's interest rates going up on the 10-year, will potentially point to better yields coming. So people will rather hold dollars and earn yield than hold gold for now. Until such time as the contagion becomes disorderly, then everyone goes capital preservation. And then instead of all that bond money going into the overpriced equity market, we may see a bigger slice ending up in the precious metals. But we have to go through this process. And right now, I think it's a bit of an ordinary spell short term for the precious metals, which is one of the things everybody's going to want to know. Francis, what's your take for gold and silver?
The interplay of rising interest rates, currency strength, and debt challenges continues to shape the financial narrative as we enter 2025. While gold maintains its allure as a hedge against uncertainty, market conditions suggest a period of consolidation before the next significant move. Shifts in capital allocation highlight the delicate balance between risk appetite and safe haven strategies, underscoring the importance of adaptability in navigating today's economic complexities. What strategies should investors adopt to balance opportunity and risk effectively in this shifting landscape? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.